I don't think, and this is what's really come out of the minutes, that they're planning on doing another hike. Now, they've left the door open, of course, because they don't know what's going to happen. But the reality is they can't control inflation at this point anyway. And so I don't think that we're going to see any other hike. If we do like the last one, I think it'll be a vanity hike. This isn't a policy measure. This is literally just to put your sort of foot in the sand and say, look, we've done it. We're in control. But that's not really policy. That's personality.
Federal Reserve officials expressed concern at their most recent meeting about the pace of inflation. They said more rate hikes could be necessary unless conditions change. Minutes released Wednesday from the session indicated. According to Dr. Nomi Prins, best-selling author and geo-economist, the recent minutes indicate a possibility of another rate hike being considered. However, the Federal Reserve has kept the option open due to uncertainties. She contends that their capacity to manage inflation is currently constrained. Nomi doesn't anticipate another rate hike similar to the previous one, as she believes it could be more of a symbolic gesture rather than a practical policy move. Fed policymakers raised interest rates to 5.25 to 5.5% on July 26th, the highest since 2001. Moreover, the Federal Reserve's aggressive monetary policy tightening has been the most significant headwind for gold, and the precious metal continues to struggle in this environment. Regarding inflation control, Nomi argues that the Federal Reserve's influence is confined to specific aspects of the economy, such as lending rates and mortgages. She believes that broader economic factors like supply chain disruptions and geopolitical tensions can also contribute to inflation, and these may be beyond the Federal Reserve's control. Inflation eased to 3.2% in July on an overall basis, down sharply from a high of more than 9% in mid-2022. Fed officials did acknowledge that they would need to take the potential cost to the economy into account. Higher interest rates can slow hiring sharply, partly by making it more expensive for companies to get business loans, potentially pushing up unemployment and even tipping the economy into a recession. Now let's watch excerpts from Dr. Nomi Prince's interview with David Lin. Before we start, smash that subscribe button and remember to enable post notifications to stay updated on our latest uploads. Thank you, and enjoy the video.
I don't see the need for them, as it seems from their minutes and the whole sort of mixed messaging behind not just the minutes, but also the Q&A that accompanied the 25 basis point move that we saw last time. I think that was a vanity move to a large extent, because at that point, at the last meeting, we had already seen inflation, which is the sort of barometer of what the Fed is supposedly looking for, come down. Federal Reserve Chairman Jerome Powell had talked about being data dependent, but then he also left the door open for another rate hike. I think that was basically to appease a sort of confidence boosting, sort of vanity, ego type of rate hiking at that point, because the last hike wasn't really data dependent. So I don't think that we're going to have another one, because the data really hasn't shown us that we really need to, or specifically, and I've said this for a long time now, that the Fed has the ability to control inflation whatsoever at all anyway at this point. I mean, yes, they have an ability to control the level at which lending happens, the level at which mortgages occur, the level that people pay on their credit cards because of the level that rates are at, but they don't have the ability to control the supply chain. They don't have the ability to control any additional geopolitical tension we might see with respect to the price of oil, which could, sort of turn into more inflation from the standpoint of energy prices and so forth that we may see to come. So they're in this position where they wanted to take in a victory lap based on what they have done with the 525 basis points of now total hikes that they've done since last March. And I don't think, and this is what's really come out of the minutes, that they're planning on doing another hike. Now, they've left the door open, of course, because they don't know what's going to happen. But the reality is they can't control inflation at this point anyway. I don't think it means that the economy is only going to grow from here. There'll be pockets of the economy that will grow. For example, this entire time that the Fed has been raising rates, we have seen a factory boom in the middle of the United States, in the West and the far West, that has far superseded any factory boom we have seen since World War II. Now, we're not paying attention to that because we're looking at the overall economy. But for example, the figures that came out in April to show the factory production of new factories being built were 4 times that of prior Aprils. That's during COVID, that's pre-COVID. So we've seen a lot of funding go into an element of the economy, in particular, the part of the economy that is going to produce, the part of the economy that's been stimulated to an extent by a combination of private investment in those areas, as well as some very large bills that came out of Congress and bipartisan bills, the Inflation Reduction Act, the bipartisan Infrastructure Act, as well as the CHIPS Act and other forms of acts along the way that have basically allowed for this funnel of funds and subsidies to go into real creation of real factory manufacturing construction that has really happened and is kind of off the charts in the middle of the country. So parts of the economy are going to grow and have been growing anyway. Other parts of the economy could continue to slow down. We could see a continued slowdown in the housing market. We could see a continued slowdown in business lending and small business lending, not these sort of large production measures, which are somewhat connected to government funding as well as private investing, but to individuals. We are seeing banks collapsing right now. We are seeing, Fitch and Moody's basically downgrade or looking to watch on downgrade more banks for more potential failures. That's going to constrain lending. Constraining lending is going to constrain parts of the economy that require lending. So it's going to be a very mixed environment. It's not a be-all, end-all for the economy growing or the economy shrinking. Parts are going to grow, parts are going to be constrained. And I think net, the Fed's number of 1 to 1.5% GDP growth is not far off from what we're actually going to see. So it's a little bit of growth. You take what's actually inflation out of that growth, and we're pretty much stagnant overall. But again, some parts are increasing and some parts are declining.
The BRICS nations are on the verge of a groundbreaking announcement that could send shockwaves through the global financial markets. Nomi emphasizes that there is a growing interest among British nations to establish economic leverage and a trading bloc that can serve as an alternative to the dominance of the Western United States dollar-based environment. This doesn't necessarily mean these countries will cease trading with the United States, but are seeking to create a more balanced and powerful economic bloc. Speculations abound that these emerging market powerhouses may unveil a new gold-backed digital currency during the summit, a move that some experts predict could challenge the US dollar's reign as the world's default currency. Nomi believes that this focus on a gold-linked or unified currency could increase interest in gold as a valuable asset, not necessarily to replace the dollar, but to provide a stronger foundation for internal trade within the bloc. Let's get back to the interview.
One of the main objectives of the BRICS and the sort of greater BRICS, the 40 countries or so that want to be a part of it, is to have some sort of a trading and economic leverage to the sort of Western United States dollar-based environment. It's not to say that they're going to all stop trading with the United States and its allies or anything like that, but it's the idea that as a bloc we have that kind of economic power. And I've been involved with a lot of the development, analysis, and research of the BRICS since the beginning, and a lot of the BRICS policies and their sort of manifesto that's come about occurred in the wake of the financial crisis of 2008, 2009. That's when the main countries said, look, we are not comfortable with the instability of the dollar. We're not comfortable with the Fed. We're not comfortable with the banking system kind of chaos. And we want our own thing. Now that's grown into, we want to have our own energy sources. We want to have our own trading blocks. We want to have our own ability to trade with each other, whether it's call it petro brick or whatever it becomes, but effectively to sort of monetize commodities with each other. And we also have the resources. So why shouldn't we do that? And so we're at a time now where what's going to come out of this conference isn't going to be the answer to all of that. This is the 15th summit that these countries have had. It just happens to have a lot more attention and happens to have a lot more countries who want to be involved. And as a result, that's what we're going to be talking about. What does that mean? Well, for one thing, it's not on the agenda, but there's obviously talk about some sort of a gold-linked currency or some sort of a unified currency through which the BRICS and any expanded BRICS countries can trade in with each other or can settle balances in country to country. Now, so the average person in the street has like a brick gold thing, but that basically ultimately there's some sort of a trade balance currency. So that's going to get discussed, I think, in the ether, even though it's not currently on the agenda for the meeting. And what that's going to do is make people take a closer look at gold, I think, throughout the world. Obviously, central banks, those particular central banks, the BRICS banks, as well as some of the greater BRICS banks, have been buying more gold recently. China, of course, has been leading that in terms of the expansion of gold buying. But it's not to necessarily have a gold-backed currency. It's to have a gold potentially linked currency. It's not going to replace the dollar, but it's going to be something that they can work on amongst themselves and use amongst themselves in the future. That's going to create more attention to gold. That's going to create more attention to the fact that gold is a scarce resource. And that's going to, I think, ultimately put a bigger bid for gold. Now, central banks are only about 15 to 20% of the owners of gold in the world, of mined gold. So there's certainly other actors that can really come on board that as well. But and also it's not just gold, it's energy. It's a pooling of rare earth minerals. It's a pooling of energy resources. It's pooling of uranium. It's a pooling of fuel, of natural gas, of oil. And basically the idea that we can fund each other's projects, energy projects, as well as trade with each other, potentially in either agreement through our block or ultimately in some sort of currency units that we may want to be talking about. So the investor should look at that as well, is what kind of fuels, what kind of resources are basically going to be pooled together by the BRICS countries, and where does that leave the demand and how that demand is going to be met in the rest of the countries. And that's going to cause some price squeezes of a number of those resources, like uranium, like lithium, like resources that are part of the sort of energy, both transition and also some of it's going backward. Natural gas, I think, is also going to really see upside from this as well, because there's kind of a realignment as to there has been happening on that basis as well. So we're going to see prices in some fuels rise. We're going to see prices in some fuel commodities rise, and critical minerals rise, and also gold from a financial commodity rise, I think.
The Fed's decision to hike interest rates increases demand for the dollar, leading to depreciation in other currencies. This poses a negative impact on the investment holdings that are denominated in non-dollar currencies, resulting in losses. How will the Federal Reserve's actions on rate hikes shape future economic stability? Please share your thoughts in the comments section below. If you found this video informative, remember to give it a thumbs up. Subscribe to our channel and enable notifications to stay informed about our latest videos on silver, gold, and copper. Thank you for watching, and we appreciate your support.